Hello and welcome back to Stock Simplified. I'm Shreya, your AI guide, and today we're talking about the different types of stocks. If you've ever wondered what the terms common stock, preferred stock, large cap, small cap, growth, or value stocks mean, you're in the right place. By the end of this episode, you'll have a clear understanding of these categories and how they can impact your investment decisions. Let's dive in. Let's start with the most fundamental distinction: common stocks versus preferred stocks. These are the two main types of shares that companies issue. Common stocks are the most well-known type of stock and what most people think of when they talk about owning shares. When you own common stock in a company, you have voting rights in shareholder meetings and can vote on key company decisions, like electing board members. Most importantly, owning common stock gives you a claim on the company's profits, usually in the form of dividends. However, dividends on common stock are not guaranteed. Companies typically pay them when they're doing well, but they can reduce or stop them if they need to conserve cash. Preferred stocks are a bit different. They don't usually come with voting rights, but they offer more stable dividends. Preferred shareholders get paid dividends before common shareholders, and in the case of bankruptcy, they have a higher claim on assets than common shareholders. Think of it as a blend between a stock and a bond, more stability than common stock, but usually less potential for growth. Preferred stocks are often attractive to investors who want a steady income stream, while common stocks are better suited for those looking for long-term growth. Next, let's talk about the difference between large cap and small cap stocks. These terms refer to a company's market capitalization, or the total market value of all its outstanding shares. Market cap is an important metric that helps investors categorize stocks by the size of the company. Large cap stocks are companies with a market capitalization of Rs 20,000 crore or more. These are big, well-established companies like Reliance Industries or Tata Consultancy Services. They're often considered safer investments because these companies tend to be more stable and less volatile. However, they may offer slower growth compared to smaller companies. On the other hand, small cap stocks are companies with a market capitalization of less than Rs 5,000 crore. These are often newer, smaller companies with the potential for rapid growth. However, they come with higher risk because they are more volatile and less stable than large cap stocks. In between, we also have mid-cap stocks, which are companies with a market cap between Rs 5,000 crore and Rs 20,000 crore. They offer a balance of risk and reward. Now let's move on to another important distinction: growth stocks versus value stocks. These terms refer to different investment strategies based on how a stock is priced and the potential for future earnings. Growth stocks are shares of companies that are expected to grow at an above-average rate compared to other companies. These companies usually reinvest their profits back into the business to fuel further growth, so they often don't pay dividends. Investors buy growth stocks with the expectation that the stock price will rise significantly over time. Examples of growth stocks are often found in industries like technology, where companies are innovating rapidly and expanding quickly. While these stocks offer the potential for high returns, they can also be more volatile and risky. Value stocks are shares of companies that are trading at a lower price than their true worth, based on metrics like earnings or book value. These companies might not be growing as fast as growth stocks, but they're often more stable and may pay dividends. Investors buy value stocks with the expectation that the market will eventually recognize the company's true value and the stock price will rise. Value stocks can be found in more established industries, like finance or manufacturing, where growth may be slower but more predictable. So, how do you decide which type of stock is right for you? Here are a few tips to guide your decision-making. If you're more risk-averse and prefer stability, you might want to focus on large cap and value stocks, which tend to be less volatile. On the other hand, if you're willing to take on more risk for the potential of higher rewards, you might explore small cap and growth stocks. Your investment goals will also play a big role. If you're looking for long-term capital appreciation, growth stocks or small cap stocks might be a good fit. But if you want a steady income through dividends, preferred stocks or value stocks may suit you better. How long you plan to hold your investments matters. If you have a long time horizon, you can afford to take more risks and wait for growth stocks or small cap stocks to appreciate. However, if you need stability and income in the short term, large cap or value stocks might be the way to go. Let's do a quick recap before we wrap up this episode. We covered 4 main categories of stocks. Common stocks give you voting rights and potential for long-term growth, but dividends are not guaranteed. Preferred stocks offer more stable dividends but usually don't come with voting rights. Large cap stocks are well-established companies with lower risk, while small cap stocks offer higher growth potential but come with more risk. Growth stocks are for investors looking for high returns and are willing to accept more volatility, while value stocks are undervalued companies that provide stability and often pay dividends. Understanding these categories can help you make more informed decisions when building your portfolio. And that's a wrap for today's episode. I hope this helped you understand the different types of stocks and how they fit into various investment strategies. In the next episode, we'll dive into dividends and how they work, so make sure to tune in. If you enjoyed this episode, please subscribe and share it with your friends who are curious about investing. And if you have any questions, send them in. We'll answer them in future episodes. Thanks for listening, and as always, happy investing.